This presentation discusses income, poverty, and healthcare. Income provides us a means of consuming and saving. It can be from payment for labor, payment from other factors, or gifts and government transfers. Distribution of income is the way income is allocated among the population based on groupings of residents. A Lorenz curve is a geometric representation of the distribution of income. A perfectly straight Lorenz curve represents complete income inequality. The more bowed a Lorenz curve, the more unequally income is distributed. Here is a Lorenz curve. The Lorenz curve is a mapping of cumulative percentage of households to cumulative percentage of money income. A 45-degree angle means that the percentage of households is equivalent to the percentage of income, or that each household represents the exact same amount of income, which represents complete equality. The gap between the 45-degree line and the Lorenz curve is inequality gap. Some complaints about the Lorenz curve include the fact that it doesn't include income in kind, income received in the form of goods and services such as housing or medical care, contrasted with money income, which is simply income in dollars or general purchasing power that can be used to buy any goods and services. Additionally, it does not account for differences in sizes of households or the number of wage earners households contain. It does not account for age differences, and it ordinarily reflects money income before taxes. It does not measure unreported income. The Lorenz curves for the U.S. economy from 1929 and 2015 indicate a decrease in income inequality since 1929. The following table shows the percentage share of income for households before direct taxes. The table groups households according to whether they are in the lowest 20% of the income distribution, the second lowest 20%, and so on. Here's the table. Distribution of wealth. Income, which is a flow, can be seen as a return on wealth, which is a stock. The distribution of income is not the same as the distribution of wealth. Wealth includes tangible objects and human wealth. Here we see that the distribution of wealth shows roughly 35% of wealth is owned by the richest 1%, roughly 34% of wealth by the next 9%, and roughly 31% of wealth owned by the rest of the economy, or the remaining 90%. So we know that incomes are different for different people, but why? If we know, maybe we can change policies or better understand their effects. Let's look at 4 determinants of income differences. They are age, marginal productivity, inheritance, and discrimination. The age earnings cycle is the regular earnings profile of an individual throughout his or her lifetime. Roughly, earnings from about age 18 are relatively low, and they gradually rise until about age 50, where they start to fall again until retirement, where they become zero. Here's the typical age earnings profile. You can see the rise from about 18 until roughly 50, where it starts to decline until retirement at 65. Marginal productivity depends largely on talent, experience, training, and investment in human capital. This is roughly how good you are at your job compared to the other person. Inheritance. 10% of inequality can be traced to inheritance. Discrimination is different pay for equal marginal rate of production, or equal pay for different marginal rate of production. The productivity standard can be summed up by the sentence, to each according to what she or he produces. It's also called the contributive standard or the merit standard. Equality, the egalitarian principle, can be summed up as to each exactly the same. Throughout history, mass poverty was accepted as inevitable. However, sustained economic growth has wiped out mass poverty in many countries. So how can there be so much poverty in the United States when wealth is abundant? While the poverty rate has declined since roughly 1959 and held steady around 15%, we see that it increased roughly during the Great Recession of 2008 and moving forward, and has stayed still steady around 15%. So how do we define poverty? The official poverty level in 2011 for an urban family of 4 was around $22,000. This is adjusted based on CPI and does not include transfer payments. Absolute poverty is not the same as relative poverty. In a relative sense, poverty will always exist, even if absolute poverty is eliminated. Social Security is a major income maintenance program. Roughly 90% of all employed persons are covered. In 2013, 55 million people received checks averaging $1,000 a month. Supplemental Security Income, or SSI, guarantees a minimum income for the aged, blind, or disabled. Temporary Assistance to Needy Families is a state-administered program financed in part by federal grants. The program provides aid to families in need. Food stamps are government-issued coupons, or e-debit cards, that can be used to purchase food. The Supplemental Nutrition Assistance Program, or SNAP, provides government-issued electronic debit cards that can be used to purchase food. In 2013, almost 1 in every 7 citizens, including children, was receiving SNAP benefits. The Earned Income Tax Credit Program is designed to provide rebates to low-income workers. Each year, the federal government grants more than $46 billion in these credits. Over 1/5 of all tax returns claim an EITC. Since 1973, there doesn't seem to have been a reduction in poverty rates. The poverty rate has remained roughly around 15%. Healthcare is tied closely to income and poverty. In the U.S., the portion of national income spent on healthcare has steadily risen since 1965. 16% of U.S. real GDP is devoted to spending on healthcare. Per capita healthcare spending in the United States is greater than anywhere else in the world. This histogram shows the rise in percentage of total national income spent on healthcare. So why have healthcare costs risen so much? Several answers are the age healthcare expenditure equation, new technologies in the medical field, and the introduction of third-party financing, or insurance companies. Third parties are parties that are not directly involved in a given activity or transaction. Third parties, including insurance companies or government, may pay fees. This graph shows the transition from mostly out-of-pocket healthcare expenses in the early 1900s to mostly third-party payments for healthcare since about 1965. Here we can see a demand for healthcare services based on the price charged. A large percentage of medical service payments are made by third parties. So the price to the consumer drops and the quantity demanded increases. An individual with a zero deductible may engage in a less healthful lifestyle because they're paying less for medical care to supplement. In this chart, we can see the large increase in federal Medicare spending since 1965. Due to the third-party payments, patients don't have to worry about the cost of surgeries and other medical procedures. Physicians and hospitals order more procedures since they are reimbursed on the basis of medical procedures. The expenses of Medicare are one of the more important federal government problems faced today. The number of beneficiaries has increased from 19.1 million in 1966 to more than 42 million in 2015. Federal spending on Medicare has increased about 10% a year, adjusted for inflation. In March 2010, President Barack Obama signed a law that governs the future operation of U.S. healthcare markets. Some of the key features include government health insurance mandates, government healthcare subsidies, and government health insurance exchanges, as well as regulations and taxes. Health insurance exchanges are government agencies to which the National Health Care Program assigns the task of assisting individuals, families, and small businesses in identifying health insurance policies to purchase. So what economic effects can we expect from the higher healthcare spending and worsened moral hazard problem? Because the price people actually pay out of pocket will decline, the quantity of healthcare services would be expected to increase. Because health insurers will be required to cover an expanded quantity of services, total expenditures on healthcare will increase, and because people will pay a smaller portion of the actual cost of treating health problems, more individuals will have reduced incentives to make decisions that promote better health. Impacts on the rest of the U.S. economy include impacts on the labor market, where the effective wage rate will increase since firms are required to provide health insurance. The market for goods and services, where the increase in labor costs that firms incur will raise their marginal costs and thus their output prices, and government budgets, where the federal government ultimately will have to search for ways to reduce its healthcare expenditures and raise more tax revenues to fund the program.